Excellent. Thank you so much, Haley. So you're going to get a panel discussion today because we have a tendency to argue amongst ourselves as analysts about what's really happening in the IT services space and which vendors that we cover and that each individual analyst covers individually is doing well or is not doing well or is making the right moves or has the right strategy or has the best performance. So what we're going to do today is we're going to take three big themes about IT services and the broader market, and we're going to have each one of these analysts talk about a particular vendor that they cover related to that particular trend or theme. And then at the end of it, we're going to have a little a judge and jury. It's actually going to be James and I that are going to decide which of the analysts made the most compelling case. So that's the basic format, and I would strongly urge folks as you're listening to, if you have questions about specific vendors that we talk about or about a specific trend, to go ahead and throw them at us. And then honestly, if you have a favorite, if you think somebody's argument about why the particular company they were talking about has positioned itself best as we come out of this pandemic, then please, by all means, vote on who you think ought to win. Because at the end of the day, what we're really trying to figure out is, okay, we're 2 years past the start of the pandemic, 2 years plus, who as in which company really did the best. So as you can see here, the analysts that will be presenting today, they each have coverage across a different set of vendors in the IT services space, and they'll talk about that when they talk and introduce themselves. So here are the three basic ideas, the basic themes, the trends that we're going to be talking about today. One is just about investments. It's about the way that the vendors themselves decide where they're going to put their profits, where they can put their revenues, where they think is the most important place that they need to make, whether that's through acquisition, whether that's through talent, and whether it's through even alliances, where they think they need to put their money in order to survive. And so who placed the right bets over the last 2 years, and who's positioned best for the next years. Then we'll talk about automation, and that really has been something that's come up, and particularly because of what's been happening with attrition across the IT services space. It really is, with very few exceptions, no vendor that has not been hit hard by the war for talent, by what's happened with attrition over particularly the last 6 months, maybe 9 months. So part of that equation is about automation, using automation both as a way of improving your own profitability, but also as a way of bringing something to your clients to speed up their transformation, to speed up the services that you're bringing to them. And then we're going to finish off with cloud and talking about hybrid cloud, talking about the way that the cloud hyperscalers, the way that the cloud technology partners to all the vendors that we talk about have had an impact on where they are now, but also, how can we look at these vendors and how can we look at the cloud vendors that they partner with and think about what's coming in the near term. So with that, we will start with this first one, the key investments driving revenue growth. And I'm going to turn it over to Elitsa to introduce us to the IT services segment broadly. Elitsa?
Thank you, Patrick. So I want to start by giving you a view of the state of the IT services market and the growth trends over the past few years. This graph is from TBR's IT services vendor benchmark and includes 31 major IT services vendors. We're showing you a historic view just to see the trends, and it was a bit of a roller coaster over the past few years, especially during the pandemic when we had a big dip in growth, and now we have a recovery and an uptick in 2021 and into 2022. So the unexpected lockdowns and the uncertainty that was caused by the pandemic pressured IT services spending and caused a deceleration in revenue growth in 2020 compared to 2019 and 2018. This graph specifically provides overview of the 31 vendors in the benchmark. So when we talk about growth, it will be about those 31 companies. So the pandemic overall was a catalyst for change, both for clients and for vendors, because they started to look for ways to run their businesses in a challenging market environment. They were looking for ways to establish remote workforce models, improving communication and collaboration, making sure that supply chains are resilient, improving data security, and shifting from traditional online sales from traditional to online sales models. So these are just some examples that the clients needed to help with during 2020. But the main lever that IT services vendors used to address those needs was technology. And notably, cloud and cybersecurity became the core enablers for digital transformation that was initiated during 2020 and scaled significantly during 2021, leading to that spike in revenue growth that we see on the graph during this past year. Vendors are also diversifying their revenue streams, and they're investing in resources and capabilities in areas of growth such as around human resource related services, product engineering, sustainability, supply chain optimization, and data related services. So this is also contributing to growth in the past year and this year as well in 2022. The speed at which revenue will grow during 2020 depends on multiple external factors, such as the pandemic. It's still a topic. And, you know, we may get some restrictions that result from the pandemic. Again, who knows? You know, some of the supply chains may get disturbed. The war in Ukraine is another factor, and the uncertainty that's caused around the war globally. And then the shift in monetary policies of the U.S. Federal Reserve. So this is our expectation. What you see on the graph is what we currently expect based on companies' results reported in 1Q22. So we are updating our expectations, but this is so far what we see for our 31 vendors in the benchmark in terms of revenue growth over that's going to happen this year. Now, if we move to the next slide, we have the vendor landscape from the latest IT services benchmark. We see a very diverse picture in terms of vendor positioning. You can all see it on the graph, that they're all scattered across the place. The bubbles reflect vendors' revenue size. The x-axis represents vendors' revenue growth for the full year 2021, and the y-axis is vendors' operating margin for the year. So this is where we'll start our discussion by vendor. And Wipro is the fastest growing on this graph, but we'll cover Wipro later in this presentation in the context of cloud. So the second in terms of growth on the graph is Accenture, and I'd like to turn it over to Boz to begin with Accenture. Boz, over to you.
Thank you, Lisa, and thank you everyone for joining us today. So I'll try to make my argument here about Accenture, why I do believe Accenture won the COVID war and is well positioned for post-COVID world. So just a couple of data points that I believe will support my argument here. So the company added $9 billion in net new revenue in 2021 over 2020 to reach $53.7 billion at the end of 2021. So that was a $9 billion. And we're seeing them adding just about as much, about $10 billion in 2022, just the way the trajectory is of growth, the bookings pipeline, and just overall positioning in the market. The growth that added those $9 billion was 20.1%. We know that Accenture captures and invests in acquisitions and just backing off some of the inorganic component. The inorganic growth contributes about 5% to those 20%. So still, even when we back it out, there's still a significant portion from an organic growth perspective. Just a little more context here of the organic versus inorganic piece. The two largest purchases, Umlaut and Novetta, that the company spent about $2 billion, helped them add less than $1 billion combined. Umlaut helped them generate $415 million, and Novetta was about $355 million. So even with those two largest purchases, that helped them, it's way less than the overall $9 billion contribution that the company did. Just to compare, in the previous year before the pandemic, Accenture only added $762 million in 2020 over 2019, and growing at the 1.7%. So a significant uptick. Just the numbers are quite impressive, just to say the least overall. Just to the position to the market and the rest of the company that we see here on the bubble chart. Accenture's revenue in 4Q21, as it's plotted on the graph, was almost $15 billion, $14.96 billion. more than twice its closest competitors, including TCS, which was $6.5 billion, IBM $6.2 billion, and even if we had to add Kyndryl before a split, the combined revenue would have been 10.8. So even then, essentially, would be a time and a half. And Capgemini was 5.6 billion. The growth, the 2021 growth rate was the fastest on record, and it was bolstered by investments in cloud, cyber, interactive services, AI, and in what they call Industry X. And it's really well positioned to continue to generate, that consulting and outsourcing growth. We've seen momentum and kind of capitalizing on its household name status in the market. I mentioned about acquisitions. They spent about $4 billion on 46 transactions, which makes it to one transaction per week on average, give or take, which, thinking about the scale and the pace of the integration, that requires significant, just the culture and the organization and the process that's required to execute on those not very many acquisitions. It's certainly something that allows them to, it's well balanced, I should say. From a headcount perspective, at the end of 2021, the company was at 675,000 people, getting closer to 700,000 in 1Q 2022. The company added over 160,000 people in 2021 over 2020, and with less than about 10% of that headcount came from acquisitions. So again, organic push. Everyone knows about Accenture's inorganic story and acquisition story, but there's certainly, when you peel back the numbers, there's still a significant momentum of organic command and control culture being executed at scale. Attrition, which we know it's a problem for everybody. Accenture is not immune to that trend. Was at 17% at 2022, a bit higher than Accenture's historical average, but relatively in line with the IT services average for the year. So overall, just kind of like still maintaining that momentum from a resource management perspective. And last but not least, the partnerships that the Accenture manages across the ecosystem, because we know Accenture, as successful as it is, it cannot do it all by itself. It's really well positioned within the partner ecosystem. The company manages over 200 relationships at the global scale, but about top 10 of those over 200 actually help it generate over close to 50% of total sales. So it is, again, well-balanced messaging to the partner ecosystem, just looking at 10 vendors helping generate about 50% of the sales, and the other over 200 helping for the other 200, for the other 50%, but still partners are vying for Accenture's attention when it comes to building momentum, building relationships in the front end from a consulting business. So that's the case for Accenture. I'll turn it over back to Elita. Elita?
Thank you, Boz. And I'll talk about the third vendor on this graph in terms of revenue growth, and that's Capgemini. Capgemini is one of the vendors that has been growing strong over the past 4 quarters on an organic basis. In 1Q2, it was in the teens. So, outperforming many of the IT services peers in terms of organic growth, and then there were some inorganic contributions as well with smaller size acquisitions in this past quarter. One factor for success in a Capgemini for this growth was Capgemini's consistent portfolio investment over the recent years, and the focus was around digital, cloud, data, AI, and cybersecurity. So positioning those segments at the center of its strategy improves Capgemini's value proposition around delivering insights-driven transformation to clients' business models, addressing application transformations and IT infrastructure transformations. Along with portfolio investments, Capgemini developed an industry-focused approach in its portfolio, and also focused on building client relationships by positioning as a strategic partner with client CXOs. So this supported the company to expand and sustain its expansion over the past 4 quarters and capture growth opportunities, and for the first time surpass $5 billion in revenue for the quarterly revenue in 1Q22. Another factor for Capgemini's success was the Altran acquisition that the company made in 2020. This acquisition is already integrated, so we already accounted for the inorganic contribution in terms of revenue growth. So this graph does not represent inorganic contribution from Altran. But from a portfolio standpoint and from resources standpoint that were brought into the company, I think this acquisition made a big difference for Capgemini because it expanded into a new service area, which is engineering services and intelligent industry, and enabled the company to diversify its portfolio, to get into a new segment, to better address clients' needs around IT and operational technology changes. Altran also brought consulting capabilities, specifically around product and service design and technology consulting. And establishing those product development capabilities diversifies Capgemini's professional services offerings and improves its ability to deliver those intelligent industry solutions and explore opportunities for growth in new areas such as biotechnology or quantum computing and AI. The Altran acquisition also strengthens Capgemini's engineering services around creating and licensing intellectual property and improves its ability to compete better with established peers in the segment such as Accenture, IBM, and Atos, for example. And since services is a people-driven business, talent is Capgemini's core asset, and the company places very high emphasis on developing its people. Capgemini has been developing people-related strategies around promoting and managing talent and positioning as a great place to work, learn, and develop. So investments in around talent development through training and reskilling, such as around on digital and cloud to support the portfolio expansion, increasing employee safety during the pandemic, fostering diversity, supporting a satisfying and rewarding environment. Such activities improve the company's ability to address dynamic demand. So going forward, we expect Capgemini will continue to grow revenue organically, taking a leading position among its peers, increasing portfolio innovation with partners and with startups, and doing joint research initiatives with academia will also contribute to sustaining revenue growth. We expect Capgemini to support portfolio innovation, to continue those efforts, and to build resources to be relevant to demand and even invest in new areas such as more into quantum computing, expanding metaverse-related solutions, and in expanding solutions around synthetic biology. Additionally, the company saw significant acceleration in signings growth in 1Q22, and its healthy pipeline with an increasing number of large transformational deals that create models for revenue growth and for cost improvement, also combined with human capital investments, will aid the company continue to grow in 2022. Now I'd like to take a pause and turn it over to John, who will take us through a vendor from the public sector. John, over to you.
Thanks, Alitza, and good afternoon, everyone. I'm going to spend the next few minutes talking about Maximus, who is an IT vendor that has operations in both the U.S. state government markets as well as the U.S. federal government, and the reasons why I nominated Maximus as being the vendor that navigated the pandemic most successfully. And I think the best place to start is to go back to the time period just before the pandemic really began to ramp up, and that would be the beginning of 2020. So let me take a few minutes to orient everyone to the graphic that we have here on the slide. And we've presented here three different views of growth. The two views of growth from Maximus federal business as well as their state government business, and then the third view, the line with the least amount of volatility in it, is the average from the TBR public sector benchmark that I author. Now, you can certainly see that there's a lot of variability in both markets for Maximus, and I'm going to dive into some of the reasons for that over the next few minutes. Maximus, as I mentioned, they operate in both the state government as well as the federal sector, and in both markets over the last 2 years, particularly during the height of the pandemic, Maximus proved itself really able to provide citizen services, uninterrupted citizen services. It's to provide citizens uninterrupted access to vital government benefits, even as the pandemic was accelerating. And this was really driven by Maximus' legacy in providing IT-enabled health and human services for government clients, not only in the U.S. federal market, but the U.S. state government market, as well as internationally. So they've been doing this for a while. So they, as a result of that, they were really ideally positioned when the pandemic hit to provide the kinds of services that federal and state government clients needed and needed quickly. So we'll begin on the state government space, and you do note some variability. This is the darker green line on the graphic, where Maximus their revenue growth in that market did accelerate quickly, and it has been kind of tailing off since then as the effects of the pandemic wound down. But kind of counteracting that has been their performance on the federal side. Now, they were providing many of the same services across both sectors, but there was a caveat. The dip that you see, the bottom of the trough in terms of their federal growth in 1Q21, that was due primarily to the impact of a large strategic contract that they had with the U.S. Census Bureau that had not been, it wasn't renewed. There wasn't an opportunity for renewal, but they weren't able, there was a contract that did have a definitive endpoint, and Maximus did not have something to immediately replace that. And even the additional COVID-related response work that they were doing in the federal market wasn't able to fully offset the impact of that. However, when their federal growth did bottom out in 1Q21, within the space of 6 weeks, they made 2 strategic acquisitions that were solely beneficial to revenue growth in the federal space. And that's the reason why you see the spike in their growth in the subsequent quarter, and the continued strong performance of their federal business, while their U.S. state business has kind of slowed down as the pandemic has wound down. So Maximus was able to successfully and very quickly, I might add, respond to the needs of their federal and their state government clients. For example, they, in the space of just a couple of weeks, they hired and or redeployed over 4,000 workers, some on-site, some remote, to assist their state government clients with support services, clinical support services in the areas including vaccine information, hotline services, and vaccination appointment scheduling. They did a lot of the same work. Their largest healthcare-related customer in the federal space is the CDC. They're certainly benefiting from the fact that the CDC did receive one of the largest funding boosts and for them, the largest funding increase in over 2 decades as a result of the Biden administration prioritizing health and civilian sector spend. So Maximus was able to pivot very quickly, was able to ramp up operations very quickly, but the challenge that Maximus is now facing is, and they've been cautioning about this for the last couple of quarters, is that pandemic response-related work is beginning to wind down as the impact of the pandemic wanes. So the new strategic imperative, replacing responding to the pandemic, replacing ensuring that their federal and state government clients have the services that they need, have the IT-enabled services that they need to respond to the pandemic. The new challenge for Maximus is how do we now parlay the relationships that we either established or that we enhanced with our successful, with our success providing COVID-related services in both sectors? How do we parlay that into longer tail revenue streams to avoid the kind of volatility that you're seeing here in terms of their top line growth, and establish a more stable and upward trajectory with their overall revenue in both the federal and state markets? This is particularly the case for them, and is going to be the biggest challenge that they face in the U.S. state government market. Whereas in the U.S. federal market, they've already laid the foundation because of their strong overall performance. They were able to make those two strategic acquisitions to bolster their federal business, pivot towards digital transformation, which is the largest overarching trend in federal IT right now. They were able to advance and enhance their own advisory-led services around digital transformation, particularly with one of the acquisitions they made, a company called Attain Limited. But all of that was enabled by the strong performance that led up to those acquisitions. So internally they parlayed their strong performance to establish the fiscal war chest, if you will, that would enable those acquisitions. They are pivoting with the market in federal. They still have a pivot to successfully execute in the state government markets. So with that, if there are any questions about Maximus, I'd be happy to address them either now or as a follow-up to the presentation. And with that, I'll hand it back to the team.
Excellent, thanks, John. I actually do have questions for John and Elitsa and Boz before we get to the judging portion of this, but I'll save them until we get towards the end. And again, if you want to put your questions in the Q&A, feel free to do so. But let's jump to the second big topic, which is automation. I'll hand it back to Boz.
Sure, thank you, Patrick. Yeah, I mean, in terms of automation, it's been an ever discussed topic of like how much automation will impact the value proposition of the vendors. Will be the impact on the go-to-market efforts, the sales motion, the pricing motion, the staffing levels, and all that. And it looks like we have reached an inflection point of like most vendors have accepted the fact that automation is really kind of becoming a table stakes, so to speak. And it's something that we want to kind of like get a little closer look into in our global delivery benchmark as a mechanism where it has the biggest impact. And is there an impact of automation on vendors' value proposition? So the global delivery benchmark, just a quick background for those who are not familiar with, it's a benchmark that tracks 14 of the largest IT services vendors and has been focused for over a decade now on the resource management strategies of those vendors, how vendors staff, where the bodies are, what type of skills they have, and really understanding the employee efficiency part of the equation from IT services standpoint. So as I started talking about, and so this graph here is from that benchmark. What it represents is vendors' profitability levels, the change of profitability between 2020 and 2021, as well as the diamonds are representing the percentage of their low-cost leverage, meaning what's the percentage of the headcount, of the total headcount of those vendors in offshore locations, because offshore locations and the staffing levels in offshore locations for years have been and continue to be, actually, I should say, a primary lever for being more profitable, to be more price competitive, so to speak. So that's a key indicator of how vendors are performing. So as you can see on the graph here, the profitability kind of like shrank for most of the vendors, and decline, I should say, maybe it's a better way to put it, as a percentage of total revenue in 2021. So it wasn't an easy task for most vendors. There's a couple exceptions, but for the most part, especially the India-centric vendors, the one that have historically had the highest profitability levels, starting to see a major decline. So why we're bringing all that is because we're looking at COVID, we're looking at understanding how the performance have impacted those vendors. So improving the sales, as we saw in the previous couple of slides that we discussed so far, are no longer enough to offset some of the increasing wage inflation and the cost of delivering services, which caused the profitability to decline for the most of the benchmark vendors. The other piece is vendors are facing profitability pressures as they continue, again, treat automation as a table stakes tool. There's not a single vendor that is really taking automation and sell it as a way of like commercialize it and sell like at scale. There's some exceptions. There's some product sales that are available to offset some of the cost of services, but for the most part, it's been used as a way to offset some of the delivery mechanisms, the cost of services overall. So vendors are trying to avoid disrupting that human delivery-centric model that they've been known for years. Because organizational change management is hard, right? This mindset approach has largely been shaped by the slow change management, as I said, roll out across organizations, and vendors struggling not to avoid massive disruptions of their go-to-market strategy, but also to engage in skilling efforts without experiencing major financial downfalls, which usually occurs when a culture transformation is executed at scale. It's just easier said than done. Go ahead and commercialize and monetize automation tools, but it's just those 90-day clocks are ticking for every vendor to report, and so that makes it much harder to make that pivot at scale. What we think about when we look at the vendor and the vendor community and why we think some of the vendors may be better positioned than others overall, we expand the vendors that are struggling to improve their profits, really to seek alternative routes, such as through restructuring programs, which will enable them to streamline operations, or by expanding the addressable market for talent recruits, investing in programs targeting non-traditional labor pools, partnering with universities, and expanding apprenticeship programs. We see that targeting recruits from underserved communities specifically could help the vendors develop emotional connections, which can result in brand loyalty and helping vendors with attrition and lowering their retention program spend. Because attrition, as we kind of pointed out a couple of times already, has been one of the biggest headwinds for vendors' overall performance, and especially on the profitability standpoint. So one of the vendors that we want to call out here, we think that is, not immune to any of the macro trends, but certainly we've seen overall kind of like managing to navigate those headwinds is Infosys. Infosys, the profit declined 190 basis points at the end of 2021 comparing to 2020, and reached 23.5%. But what is important here to highlight is that Infosys still managed to stay within guided range, which was 22% to 24% profitability. So they actually delivered the profitability at the end of 2021 was at the upper end of the guided range, despite the decline, despite all the headwinds of attrition and additional cost of services many vendors faced. So again, Infosys was had the second highest profit as a percentage of total sales after TCS, for which the operating margin declined 160 basis points to 26.6. So those two are kind of like neck to neck, but another reason I'm bringing up Infosys in discussion here is see as a vendor that is balancing automation and service delivery with profitability guided range targets is because while the wage inflation is pressuring the cost of services, Infosys SG&A expense declined 60 basis points as a percentage of revenue to 9.3% during the last quarter of 2021, and benefited largely from sales execution as well as the impact of back office automation. We know that Infosys is able to take out about 3,000 to 4,000 people from automating and putting them in bots for a quarter. So overall, as a percentage of total headcount, that's about 1.5% of total headcount, but that gives them enough for to offset some of the initial additional wage inflation and wage hikes on the cost of services. So the SG&A is a little more balanced. The other portion of the SG&A that we see them being successful is they continue to hire at scale, at bulk, just like everybody else on the delivery side, but the sales and support headcount as a percentage of total headcount actually declined 60 basis points, which is reflecting on the company's focus on its delivery as a sales strategy kind of success in the market. So that really reflects on the bigger transformation that Infosys has done over the last 3-4 years, focus on that delivery execution rather than trying to sell different things just for sake of selling the different portions of their portfolio, like a new product and platforms and whatnot. And it's really been focused on the execution side. So focus on execution and the delivery side, spending less on salespeople, and embedding automation to offset some additional wage hikes have enabled Infosys really to stay within that guided range and actually deliver margins at the upper bound of their guided range. The last piece here on Infosys that I want to highlight was going back to the comment about hiring from non-traditional channels. Infosys announced 3-year investments with Dartmouth Marshall College Fund, and we serve as a graduate pipeline partner to create job opportunities for 1,600 graduating students from historically Black colleges and universities as a way to develop that emotional connection and essentially try to offset some of the higher costs with higher wages. Additionally, company established an agreement with the Department of Higher and Technical Education in Maharashtra in India to lead about 3,900 online courses for college students. It's no cost in areas such as AI, cloud, business, and leadership. So a couple of examples of that, thinking about what's next for them, because thinking about the pipeline of resources and skills that are needed from non-traditional backgrounds to create that emotional connection is something that Infosys is also working towards. And with that, we'll turn it over to the last section, which is cloud, and turn it over to Evan. Evan, over to you.
Great, thanks, Boz. And so for the final portion here, what we really want to do is spend some time talking about the evolving partner ecosystem between these hyperscales and their IT services partners, and then also provide some clarity on some new research we have, basically to dig deeper into that, coming out next month, actually. So over the past 2 years, one thing has been made very clear. The impact of COVID on global businesses has broadened the need for cloud-enabled workloads, but where that demand is has undoubtedly shifted since the pandemic began. Early on, uncertainty led to a shift in IT budgeting as enterprise emphasis shifted to more business continuity type of requirements. As the remote work environment became more familiar, it became more clear then that cloud-based solutions would be critical to sustaining those operations. And as a result, demand across IaaS, PaaS, and SaaS surged. And the cloud hyperscales capitalized on this opportunity to accelerate their own revenue growth. For instance, vendors like Microsoft made multiple updates to remote enabling solutions, perhaps best highlighted in the company's efforts around Teams, which it quickly integrated across its core workloads like Dynamics or Office 365 to broaden its share of wallet. Outside of that, collaboration and productivity layer, Microsoft also has been really creative in how it layers capabilities to further promote client upsell. And highlighting that approach would be how it layers the EMS security offering within Office E3 and E5 to kind of promote client upsell to the more expensive premium E5 offering. In short, though, what these vendors did was built these workforce enablement platforms, which cover, productivity. They cover your core application needs, be it CRM, ERP, and so forth, and also the security that enterprises require to maintain to protect their data as their workforces were largely working from home. Lastly, outside of the application workloads, Microsoft has increasingly sought to ingrain its legacy software infrastructure expertise within Azure to support clients' hybrid IT and cloud aspirations. While offerings like Azure Arc provide the management pane, flexible pricing programs like Azure Hybrid Benefit make that transition from a legacy server product to Azure more seamless for the client and thus protects its vast legacy install base from the competitor poaching. Outside of the hyperscale organic efforts, though, providers like Microsoft have also benefited from the IT services ecosystem quickly racing to capture the substantial opportunity around cloud migration, implementation, and advisory services. The investments these partners made against the platforms then expands the hyperscale addressable market as they can leverage partners' local service experts to drive demand into their vast data center footprints, which they've only continued to expand despite the, in light of the ongoing pandemic challenges. Today, possessing a cloud platform branded business unit is really just table stakes for the services ecosystem if they hope to capture some of the vast services opportunity. And to differentiate themselves in the eyes of platform partners, it'll demand new ways of working with them to support some of these more emergent portfolio aspirations that they have. Highlighting this would be the growing investment activity by platform providers around industry-led portfolios. These emerging suites, too, align well to a more mature client base, which was forced to modernize their IT environments to sustain operations for their largely remote workforces. Now these same clients are seeking ways of using cloud to enable their more discrete business processes. But the reality is, no one cloud provider has the necessary industry acumen to understand the needs, challenges, pain points, and desired outcomes of clients across healthcare, financial services, or industrial manufacturing venues. Building the right industry solutions requires deep understanding of a client's industry and their business. Insert the IT services and consulting ecosystem, which possesses these necessary domain experts and understands best practices of how these partner ecosystems will need to evolve to make markets together, so to speak. To kind of understand how that working model needs to shift going forward, and the best practices that will come out of these efforts, TBR is set to launch next month the Cloud Ecosystems Market Landscape, which is going to assess the resource strategies and revenue performance of the 9 IT services firms listed on that graph there on the page, but against the 3 cloud platform cloud platform providers. While providing that quantitative view, it's more importantly, we're going to really look into the new relationship models being explored, such as these co-innovation centers, which pair cloud technology experts with the service domain experts of the partner. So a good example of that would be Wipro and Google, launched a co-innovation center in India, and basically Wipro is going to bring its industry experts to that location, and then they'll also be working directly with the Google Cloud technologists to kind of understand what needs to be built to make these industry suites more applicable to the customers they're trying to go out and pursue. Another good example too is efforts which PwC has done around its connected solutions business with Microsoft. So basically that connected solutions business is largely built on top of Azure, so that platform supports all the solutions they're going to market and building, while also they use that to kind of draw in ISV partners to work with them in the construct of new opportunities specifically related to industrial manufacturing through the connected solutions business. So really what that report's going to try to do is try to figure out how are these relationships going to have to evolve in order to build that next frontier of growth for the cloud platform providers, which leverages the expertise of these IT services partners going forward. And with that, I'll pass it up to Kelly, who's going to provide a bit more color on Unisys in that context.
Thanks, Evan, and hello, everyone. So as Evan mentioned, I wanted to talk a little bit about Unisys. And as we're looking at kind of the hybrid cloud, kind of the shift around there and the different client priorities there, I wanted to take a look at Unisys' approach to these cloud strategies and its portfolio and how it's kind of evolved over the past few years. And looking at that, I wanted to take a client priority approach. So some of the key elements that are a part of Unisys' cloud strategy centers around the multi-cloud complexity. And I think as clients are looking at the hybrid cloud adoption and as the vendors implement some of these larger technologies and platforms, there is that need for the multi-cloud layered services, so making sure that they're layered properly. But this does require some of the partnerships from those hyperscalers, that expertise, some of the things that Evan had spoken about. Looking at those hyperscalers, so looking at the people that work with those, the certifications, the training, Unisys' ability to offer that and ensure that they can layer those services properly helps the company to better work with clients on their multi-cloud adoption. Something else that they had spoken about quite a bit was around technical debt and reducing that for its clients. For the most part, reducing that technical debt kind of helps them with their expenses, their operational abilities. They'll process a bit better. And by technical debt, we mean more of consolidating the data center network, kind of reducing the physical footprints there. So it helps with the operations, it helps with the expenses, but also as ESG and sustainability is coming more into the client lens, it's also helping with reducing that footprint, reducing the outputs, the energy outputs, while in most cases increasing the storage, the operational capacities, things like that. One other main point when looking at the cloud complexity is that Unisys' approach, many vendors go more of that cloud journey. I don't like to use the word journey, but going from that, something that Unisys calls out is it's not necessarily a journey, it's more of that ongoing relationship, the ongoing migration. So taking it from that approach, so looking at the continual processes, the ongoing evolution, to help with the ongoing maintenance. So it's not just adopting the platform and then stop there, but it's that ongoing relationship, the ongoing maintenance around those platforms to make sure that they're still useful and they're adapted for some of the new services that the clients may be doing, or different areas around that. Looking at the security as well through the whole process and making sure that as different devices are adapted, or the way that different solutions, devices, they play together, making sure that the security is there all around and within. Also looking forward, so sometimes predicting some of the problems that may happen with the focus on agility and resiliency is a big part of the strategy as well. So looking forward to help prepare the infrastructure, prepare the employees to make sure that they can respond to new threats or just different changes in the environment. And this also includes some of that proactive cloud rationalization. So they're looking at the current problems, making sure that they can solve them, while also making sure that they're prepared for any new problems and that they're equipped well to respond to those. A lot of the solutions that Unisys offers, and including the services mostly here, it stretches beyond just the technology and the cloud solutions themselves. It does look at the employees. Security is a big thing, so preparing the employees to know how to use the technology properly, how to remain within the IT environment, and just protect the networks at all costs. So making sure that they have that organization change management so that they're more vigilant and aware of the technology, and they're also able to use the technology in the way that's most beneficial for the organization as a whole. When looking at security, I think Unisys focuses a lot on their stealth offering, and this takes a different approach where it doesn't necessarily, it goes off an identification system, so it looks to, it goes beyond just the typical perimeter monitoring for security services to help control that network a bit more tightly. And just a few final notes on Unisys here. I think a big part of their cloud strategy and their portfolio focuses around those purpose-built solutions. So it's not just executing on cloud transformation, it's also focusing on the ongoing maintenance, the ongoing relationships, and making sure their clients are able to upkeep those solutions and not just implementing them and letting them go, but making sure that they can use the solutions in the best way for their organization, looking at where they are now and where they're hoping to go, where they help them find the directions that they should be heading in. Also making sure that the clients are in the right position and that they're rationalizing or utilizing their technology or their solutions, their assets, where they should, so they don't have a heavy load. So looking at that technical debt and making sure that they have the resources in the right place. Also looking at connectivity across cloud platforms, talking about the hybrid cloud, you have the multi-cloud, the cloud-native solutions, kind of creating flexibility and interoperability between all the different platforms is really helping them to connect and provide those larger solution-driven transformations. And with that, I will hand it over to Megan.
Thanks, Kelly, and thank you everyone for joining us today. I'd like to talk a bit about Wipro and how it's pulled itself to its current position today. Wipro's growth rates for its previous lines of business all declined double digits in 2Q20 as a result of COVID, with consulting services faring the worst as it dropped to 19% year to year. Under the leadership of Terry Delaporte, who was appointed CEO in July of 2020, these five lines of business were consolidated into two upon restructuring in January of 2021. These lines of businesses are called Ideas and iCore. Through refining its business lines, Wipro has been able to better allocate its resources and investments to drive greater go-to-market efforts, particularly around digital services and cloud, spaces in which Wipro previously relied on hyperscale partnerships to roll out new solutions and deliver customer wins. This happened in the first few quarters after COVID. In 2Q21, Ideas and iCore grew 31% and 20% year to year within months after the restructuring. This was due to Wipro's inorganic investments in companies like Capco and continued relationships with cloud providers like Microsoft, Google, and Cisco. Consulting services, as a result, skyrocketed to 159% in 2Q21 as demand for Wipro's growing digital expertise strengthened. Much of Wipro's current opportunities are centered around the FullStride Cloud Services portfolio today. It's a dedicated business unit that was launched in 3Q21, and it addresses the digital transformation needs of clients through cloud-native technology. The portfolio kickstarted the execution of Wipro's cloud ambitions, as the company stated that it invested about $1 million, which will be spread across 3 years to 2024. They're doing that for the cloud practice, which that includes some talent and acquisitions. Wipro also reported 40% of its order book is cloud related, which was stated on their 1Q22 earnings call, so rather recently. Wipro has leveraged FullStride over the past year to strengthen both Ideas and iCore through cross-selling opportunities to support solutions, partner opportunities, and customer wins, which contributed to Wipro's 1Q22 revenue growth of 25% to $2.7 billion in 1Q22. The future looks bright for Wipro in this space as the company continues to build on the FullStride framework through new acquisitions and through nurturing existing cloud relationships. With all of this in mind, I think Wipro has the tools to position itself as a contender in the cloud market, making it one to look out for going forward. Patrick, right back to you.
Excellent. Thank you so much. We have a lot here that James and I have to consider when it comes to deciding which vendor out of everybody that we just heard about. So Wipro, Unisys, Infosys, Maximus, Capgemini, Accenture. Who won the pandemic? Who's the one that's going to come out best on the other side? I'm going to let James go first, and let's hear from him, and then I'll give you my verdict. James?
So I was swayed by Maximus a bit, but I think ultimately I'll have to say Boz's argument was the most convincing to me, especially considering Accenture's already notable size and revenue levels before the pandemic. They've just continued to acquire, build out relationships with partners, and keep a healthy operating margin while attrition's going up a bit. It's about as expected. I'd have to say Accenture.
Well, okay, we're going to disagree. So we're going to have a split jury on this one. I had a couple questions for Boz about Accenture. One, I was concerned a little bit about ensuring quality when you get to that size, and also what I would call the sort of the Cheesecake Factory problem, which is if you're everything to everyone, are you really good at any one thing? My question for Capgemini was more around sort of, do they need to do another Altran-like acquisition? They did that 2 years ago. It had that huge boost for them. The concern would be, do they have to keep doing that to continue to be successful? Maximus, certainly is an impressive story. Again, a bit of a question there. They were able to have that fiscal war chest that John mentioned to be able to make the right acquisition. So they certainly positioned themselves well. But I think I was most convinced by two arguments. So, and then Wipro is a good story. A lot of ambition in that story, and ambition is good to have. Good to know that they're partnering well. I would caution against too much leading too much with consulting from Wipro, but we'll see where that goes. So where I end up with is with Unisys and Infosys, and I think Unisys is interesting because they seem to be meeting the needs of their clients, not sort of meeting the trends. Talking about reducing technical debt. Talk about adopting a platform as an ongoing, as an emphasis on resiliency, on that proactive cloud rationalization. That all seems like it's addressing what the clients actually really need, as opposed to where the trends have been pushing the rest of the market. So I think sometimes there's an emphasis on trying to differentiate by being at the front of a trend, or trying to differentiate by doing something wildly different. I think in the case of Unisys, they seem to be basically doing what clients need, which is probably the most important thing. But at the end of the day, I'm going to give my who won COVID mark to Infosys for two things. One, I think they have a very smart talent strategy, which when everyone is suffering with a lot of attrition, when everyone is suffering through a war for talent, having a smart, thoughtful talent strategy is going to be what makes the difference going forward, I think. And then secondly, nothing can ring truer for me than focusing on delivery execution rather than focusing on sales. So the thinking that Infosys is saying, hey, we need to make sure we execute well all the time, as opposed to go out there and sell the next service, the next transformation, the next widget. I think that to me has always been a successful strategy. And I think coming out of the pandemic, it's probably learning one of the most important lessons that we all saw through the pandemic, which was, if you can't execute, if you can't provide for people the services they need, if you can't provide for your own people in terms of the professional development they need, and if you can't show up when things are really tough, then don't bother showing up. So I think, to me, I'm gonna give the winner to Infosys. So a little bit of a split jury here, but I guess Boz gets credit on both accounts, both of his companies making a solid argument. We had a couple questions come through that were answered actually directly by the analysts themselves who were covering those companies. So again, if you have any comments, any suggestions, any questions, please throw them to us. One correction: the market landscape that Evan was talking about is actually coming out at the end of this month. You should also look for a market landscape around decarbonization, which will be coming out, I believe, next month, and the latest edition of the Innovation and Transformation Center's market landscape will also be coming out next month. We also have the Management Consulting Benchmark, which is a semi-annual production that comes out sometime by the end of this month. We have a lot of the Management Consulting Benchmark profiles out already, and then of course the IT Services Benchmark, which you're seeing here. That coverage is every quarter, and that's led by Elitsa. So if you have any questions specifically about what is in that benchmark, or what we're going to be covering, or what the trends are, please reach out to her directly. And Haley, with that, I think we're ready to wrap.
Thanks so much, Patrick, and thank you everybody for joining us today. Please feel free to reach out to the team with any follow-up questions. Their emails are in the bio on the screen. If you have a few moments, it would be greatly appreciated if you could fill out the survey on your screen. A replay version of today's webcast will be available after the event, and it will be sent out to all of you via email. To view a list of our upcoming and past webinars, you can view that at tbri.com, and be sure to join us next week on Thursday for Cloud ERP Picking Up Speed, how vendors are capitalizing on vast opportunity. Thank you all, and have a great rest of your day.